Hello my fellow investors and welcome back to another stock analysis video. Today guys, we are going to be analyzing the company Five Below, a discount store that's actually been coming up recently, which I've never heard of it. I don't think I've seen any of them where I live, but nonetheless guys, they do have earnings tomorrow after close, and I figured, you know what, let's analyze this company to see if maybe we would like to buy it at the current share price. So with that said, let's get started with this analysis. We're going to come right into the calculator, guys. This company does not pay out a dividend. So we got the ticker symbol of FIVE, 5, market cap of 7.2 billion with a PE of 27.82. Wow, that is high. Basically saying that with the current share price of $129.54, yeah, we may want to wait for this thing to drop, but by how much? We're going to find out in just 1 second. And again, seeing that they do not pay out a dividend, this means that all of their cash flow is going straight into themselves. So now let's actually move over into the fundamentals. Starting of course with the net income, we got 5 years ago guys of 102.5 million to 1 year ago of $278.8 million. That is an increase of 172%. And as you can see, this actually doesn't look too bad, guys. It's 5, 4, and 3 consistently increasing. They went down 2 years ago probably because of COVID, so it's a perfectly understandable number. And then 1 year ago they exceeded that and they pretty much just skyrocketed. So guys, I'm actually going to give this essentially like a 95%. I understand that this is a COVID related number. I still have to take into account though. So that's essentially why I'm giving it a pretty high value of around 95%. Looking now into the free cash flow, the most important of all the profit metrics, cash from operations, less your capital expenditures. Basically, a company uses this for everything. It could use this to buy back shares, pay down debt, issue a dividend, which they don't in this case, grow the company, and make acquisitions. Very, very important, guys, for this thing to be increasing. Now, unfortunately, there's a lot of peculiar years here that we can actually see. 5 years ago of 99.6 million to 1 year ago, guys, of 39.7 million. That is a decrease on the 5 year of 60%, with a 5 year average of $70.04 million. Now, the thing here is that, well, during COVID, guys, they actually went up a significant amount to $165.8 million. 3 years ago, they went negative. So if we actually take a look at this value over here, at the 3 year ago number, we can see that it wasn't their cash from operations going down. Their cash from operations roughly remained the same, as you can see, 167.4, 184.1, and then 187. It was essentially their cap expenditures that went up a drastic amount, and they kept it high even the following years after that, but their cash from operations did go up after this anomaly that occurred 3 years ago. So, you know, it's their capital expenditures that went up, not necessarily a drop in their cash from operations, so which is a good thing. But still, see where those capital expenditures is actually going into, because if it's going into growing the company, then this might actually not be too much of an issue. But nonetheless, guys, aside from that, the cash flow isn't too good, right? It is still decreasing overall. It's not looking that enticing. So unfortunately, I'm gonna have to give this like a 40%, maybe even lower, maybe at like 30% or so. This is something that you guys would probably change as of your end, because, well, if you know where these capital expenditures are going, then you might be willing to put this at a higher grade. But nonetheless, I'm going with 30%. And now looking at the revenue, this is looking very, very good, guys. 5 years ago of 1.3 billion to 1 year ago of essentially $3 billion, increase of 122.84%. And this graph looks amazing, right? You got 5 years ago, 4 years ago, 3 years ago, and 2 years ago, all increasing, even during COVID, guys. Now, they did have a massive jump from 2 years ago to 1 year ago. So, you know, I don't really like that, right? They went from 1.962 billion to 2.848 billion. So I don't like this massive jump, probably because of pent-up demand and just inflation as a whole. So I'm actually going to give this, guys, not a perfect score, but a pretty high one at that. I would say like at around like a 95% as well. When it comes to these profit metrics, guys, honestly, not bad. Not bad. Do more research on this cash flow, see where the capital expenditures is going if you like this company, and maybe we would like to increase this 30%, because if we know where this is going, then all the other two profit metrics look really, really good. So you guys might be interested in actually inputting a higher grade when it comes to the free cash flow. Coming down to the balance sheet numbers, assets minus liabilities. Very, very important, guys, for their assets to be significantly increasing their liabilities, because if they don't, then we have a bigger problem, right? Because, well, if they don't, then their chances of going bankrupt are significantly higher. So as it currently stands, guys, they are at $1.1 billion in this difference. And if we take a look at the past 5 years, they have consistently increased this. Now this year obviously isn't over, so they actually might continue to rise this difference this year, surpassing last year's of $1.12 billion. So don't count this year out yet. Overall, I think they will surpass it. They're fairly close. Average assets around $2 billion. Average liabilities around $1.1 billion. And doing this difference, we get $825 million. Overall, guys, I'm actually going to give this, okay, I'm going to give this like a 97%. Not 100 because, unfortunately, as if I'm looking at this one is still under the previous year. I think that they will go above. I'm not saying that they won't, but because I don't see that yet, I'm going to lowball it just a little bit. Aside from that, very good total assets minus the total liabilities. Now let's actually do the exact same math, but with the cash flow. Now guys, the cash flow is atrocious, right? We have seen their cash flow go negative and it's just decreasing. So it's not surprising to see that this difference is actually getting further and further in the negatives. The reason why we take a look at this, guys, is because cash flow, it is what companies use to pay down their debts. So if we do the math, cash flow year over year and then liabilities year over year and add them or subtract them, we get if maybe they're able to subsidize their liabilities with their cash flow, or at least see, hey, at least their cash flow is increasing at a rate faster than their liabilities. And unfortunately, as of 1 year ago, guys, they're at negative 1.7 billion, and well, 5 years ago they were at negative 137 million. So as you can see, massive decrease. That's not good. Average cash flow minus the average total liabilities, we get negative $923 million. I'm gonna give this, guys, like a 5%. Like, I really don't see anything here that entices me. I would give it 0, but you know, they kind of kept it roughly the same 3 and 2 years ago, especially during COVID. That's why I'm giving it a 5%. But aside from that, guys, this is horrible. Looking now at the shares outstanding, the metric that gets overlooked, however, on this channel, we look at it because this is a really underestimated metric. This one tells you if the company is diluting you as the investor. And on top of that, guys, if a company pays out a dividend, if they're buying back shares, their payout ratio on that dividend actually decreases because this is shares that they no longer have to pay out dividends for. So it's an overall boon for this company to be buying back shares. Now, there's actually reasons as to why they might be issuing shares, and they're actually pretty reasonable as well. If a company feels that their share price is very much overpriced, they might issue shares a little bit just to get that cash back instead of taking on more debt. Now, when it comes to Five Below, guys, we got 5 years ago at 55.4 million shares to today, guys, at 55.5 million shares. On my last video, by the way, I think I kept saying dollars, so sorry about that. But yeah, 55.5 million shares today. Now, in the 5 year, this is an increase of 0.18%. However, from the previous year to the current year, this is looking at 1 year ago of 55.7 million to today of, again, 55.5 million. That is a decrease of 0.36%. So this is actually fairly interesting because from 5 years ago to 4 years ago, they increased it. From 4 years ago to 3 years ago, they decreased it. Then 3 years ago to 2 years ago, they increased it. And then they decreased it, and then they're decreasing it again. So it's interesting because, well, their increases, guys, aren't that much, right? They barely increased it by 1 million shares, if that. So it's actually not too bad. Probably they just think that their share price is pretty much overpriced, so I think that's the reason why they're issuing. And at 0.18 is not too bad. Overall, I'm gonna give this like, I'm gonna give it a failing grade, but I'm not gonna give it too low of a grade. I'm gonna give it like a 55%, just because in the 5 year it is increasing, but it's not like a massive dilution. And lastly, when it comes to the cash and equivalents, they currently hold $120.5 million with an average of $170.2 million. So now let's actually do a quick recap on all of the grades. We got net income 95%, free cash flow 30%, revenue 95%, assets minus liabilities 97%, cash flow minus liabilities 5%, and the shares outstanding at 55% for an overall grade, guys, of 64%. The biggest thing that they have here that is hurting them, guys, it is this cash flow minus liabilities and the free cash flow in general. Honestly, if they would just fix the free cash flow, this cash flow minus liabilities would solve itself, and this company might actually become like an 80% or more company. At that point, their shares outstanding isn't really much of an issue for me. So yeah, I don't think this is that bad. If their cash flow tends to grow in the future, we'll take a look at their earnings tomorrow. But if their cash flow tends to grow in the future, guys, this doesn't look like a bad buy when it comes to their fundamentals. Now let's see if at the current share price we would like to buy it using discounted free cash flow. Now, unfortunately, guys, well, we actually cannot do discounted free cash flow when it comes to this company. And, well, we actually can, but I just don't think that the numbers come out too good. I will still do it for you guys, but I'd rather use book value and tangible book value instead of discounted free cash flow. So let's actually take a look at this just to see what we actually get. Now, first of all, guys, the target share price after debt is in the negatives. This is not going to get any better because, well, they just have a lot more debt than they do cash on hand. It is what it is. I can't really change this. So let's actually just focus on this target share price now, adjusting for debt. And as you can see, it is at $1.24. So yeah, that's not too good. And the current share price is $129. Let's actually input some revenue growth and see what this actually leads to. So coming over here to Seeking Alpha, we see that the revenue growth forward is 23.05% and the revenue growth year over year is 22.5%. So fairly close to each other. Now, I'm going to be fairly conservative when it comes to this. I'm going to say significantly lower when it comes to the lowest assumption. I'm going to take into account, guys, the inflation situation, the recession situation, right? What the Fed came out saying just a couple of days ago that crashed the market. So for that reason, I'm going to say, guys, 15% revenue growth for the low assumption. Let's go up to 18% for the median assumption and 21% for the highest assumption. Now for the predicted share buyback, it's iffy. Right? It's iffy. I don't think that they'll do more than like 2%, if that, in the next 4 years at the rate that they're going. So let's actually go, guys, 0.5% for the low assumption, 1% for the median assumption, and 1.5% for the highest assumption. And here we see the target share prices of $2.07 for the low assumption, $2.29 for the median assumption, and $2.52 for the highest assumption. This is what I mean that this doesn't make any sense. So because it doesn't make any sense in accordance to this $129, let's actually take a look at, guys, the book value per share, because that one takes into account zero assumptions. So coming over here to the book value per share, we can see that today, guys, they are estimated at $20.09. 5 years ago, they were at $8.27. This is an increase of 143%. And now looking at the tangible book value per share, we can see that it's essentially the exact same thing. Currently, they're at $20.09. 5 years ago, it was $8.27. That is an increase of 143%. And now, if we take a look at the price divided by the current book value and the tangible book value, we get a ratio of 6.45, essentially saying that this is very much overpriced. Anything above 1, it is overpriced. So yeah, the price tag should be worth more than around like the $20 mark, guys. And again, looking at the current share price, guys, of $129, yeah, unfortunately, it is overpriced. I mean, we got a bunch of metrics that say it. The book value, my discounted free cash flow, if you guys would like to believe it. You know, I don't know if these $2.52 are reliable. Unfortunately, when it comes to discounted free cash flow, it works better for well-established companies that have consistent growing cash flow. This one doesn't necessarily have that, but it is what it is. And again, it really just depends as to what you believe. Does that mean that you don't buy this company? No. Does that mean that you do buy this company? No. You guys should make your own assumptions. Take a look at this company's fundamentals. You guys can have my calculator. This is all for free. This one, the book value one, the revaluation one, and a dividend tracking sheet. All links in the description below to a video where they're all consolidated there. So please have them and make your own assumptions. This is not financial advice, and every investment is the present value of all future cash flow. So guys, all I'm asking for in return for free content, we're almost to 1,000 subscribers. I plan to make a very special video at the 1K mark. And, you know, for these free calculators, all I'm asking for is just help me grow my channel. That's really it. I'm not really asking for anybody to subscribe to like my Patreon or anything like that, or affiliate link. Just help me grow my channel. That's really all I'm asking for. So you guys can do me that favor. That would be awesome. I greatly appreciate it. All in all, guys, Five Below, I think it's a company that does have a lot of good potential. Don't get me wrong. Their revenue and net income, really, really solid. That cash flow needs to be fixed. And the shares outstanding, it's iffy, but I'm okay with it. Nonetheless, guys, I think that at the current share price, it is a little bit overpriced, and their cash flow does need to be better. That pretty much does it for this video. Like if you like, comment, subscribe. It does help it with the algorithm on YouTube. You guys can follow me on my new tech sites. Link in the description below. So with that said, peace out, and be on the lookout for the next stock analysis video.